The results are now in, the US election is over, and I'm going to show you in today's video exactly why the US dollar, US equities, especially Tesla, and also Bitcoin are all set to rally off the back of this election result. Heading over to Bloomberg, we can see the headline now: Donald Trump wins US presidency for a second time. The dollar hits a one-year high as Trump clinches election victory. Surging the greenback pushes major currency peers lower. Trump's policies seen fanning inflation, keeping rates high. The dollar rose to the strongest level in a year as Donald Trump won the race for the US presidency, triggering a sharp rise in treasury yields on speculation his policies would keep US interest rates elevated. So what we've seen is, off the back of this election, we've seen bond yields, especially on the long end, rising. Now, why do bond yields, especially on the long end, rise? It's because of increased inflation expectations in the future. So if bond traders expect inflation to increase in the future, they will sell bonds now, and this will be reflected in yields, bond yields going higher. So why exactly does the market view a second Trump term as something that is likely to, quote unquote, fan the flames of inflation? What policies exactly is Trump looking to implement that could exacerbate inflation? If we head back over to Bloomberg, you can see while Trump has advocated for a weaker dollar, investors believe his policies will fan inflation and slow the pace of Federal Reserve rate cuts, ultimately boosting the greenback. He has promised to cut taxes and slap large tariffs on imports. So we can see here the two primary reasons the market is concerned about reacceleration of inflation is because Trump wants to cut taxes, which is inflationary, and because he wants to impose tariffs, which are also inflationary. So let's start by having a look at the tax cutting side of this dual policy. We can see from this separate article in CBS News that Trump's combination of tariffs and tax cuts include cutting the corporate tax rate to 15% from its current 21%. It goes on to point out, though, that it would require congressional approval, unlike tariffs. So if Trump wants to cut the corporate tax rate from 21% to 15%, what is this? It's inflationary. As you cut taxes, this is stimulative. It adds to inflationary pressures. Is there a precedent for this? When was the last time this was done? Well, actually, this was Trump's go-to tax cut back in 2016, actually early 2017. And we can go and have a look to see exactly what happened when Trump cut the corporate tax rate from around 35% to 21% in 2016, 2017. So the first thing I want to do is just pull up the US dollar index in the Hedge Dash platform, and we can go back and have a look to the 2016 to 2017 tax cut, corporate tax cut from the Trump administration. What happened to the dollar? Now, this tax cut came into effect right here. I remember this very well because I was trading it at the time, and we got this kind of technical break lower, and we had this big sell-off down. So you can see, if I just annotate this, this was where the tax cut came into effect. You can actually see the gap down here on the weekly chart for the dollar index. And we had a subsequent roughly 11 to 12% decline in the US dollar. Now, you might be saying, well, hang on a minute. If we're going to get another tax cut and it's inflationary, why would we not necessarily see the same thing? Why would we not see the US dollar selling off instead of rallying? And why did we just get a massive rally in the dollar in response to the election outcome if the market is looking at Trump cutting corporation tax like he did in 2016? Well, here's the problem. If we jump over to the consumer price index, and this is headline inflation, this is not core inflation, you can see back in 2016, and specifically when we started to get that gap down January, February, March 2017, inflation was running at about 2.4%. So if we come and have a look at it now, you can see, again, we're kind of in a similar area. We're about 2.5, 2.4%. So you might think to yourself, well, why would this be any more inflationary than it was back in 2017 when he cut the corporate tax rate? You know, why would we not see the dollar rallying in response to bond yields going up back in 2016 or 17, but why are we seeing it this time? And this is where we get the market getting concerned on the inflationary side. It's because of core inflation. So we're looking at CPI, but minus food and energy, the core component. We go back to January, February, March, when we get that gap down, and we're roughly at 2%. So we're at target when Trump starts to cut corporation tax. And you can see we don't get a kind of massive acceleration of inflation. However, look at where we are now. We're not at target. We're actually at 3.2% core inflation in the US. This is what's concerning the market this time round. So the market view is, if Trump is to come in and cut the corporate tax rate, yes, this will be inflationary, but the dollar has responded positively this time because core inflation is at 3.2%. It's not back down to 2%. It's actually above target already. So we're going to start to see stimulating measures coming into the economy on the fiscal side, with core inflation sitting at 3.2%. And this is one of the primary reasons why the market is concerned about a re-acceleration of inflation. Bear in mind, we're also seeing on the monetary policy side, the Federal Reserve cutting rates. So now we're seeing fiscal stimulus with potential tax cuts for corporation tax. And at the same time, we're getting stimulus from monetary policy as the Federal Reserve cuts rates. Not something that we saw back in 2016, the first time that Trump cut the corporate tax rate from 35% to 21%. And if we pull up the federal funds rate back in March of 2017, when we started to get the Trump tax cuts, what do we see? We see in March 2017, interest rates are low, but they're moving higher. So as Trump is easing on the fiscal side by cutting corporation tax from 35% to 21%, we are seeing monetary policy moving in the opposite direction. We're seeing interest rates going up. This time, if Trump is to come in and cut corporation tax, it's going to be at the same time as the Federal Reserve are cutting rates. So we have inflationary stimulus, not just on the fiscal side. There's nothing to offset it on the monetary policy side, as the Fed also cuts and stimulates the economy, adds to inflationary pressures on the monetary policy side as well as Trump on the fiscal side. So it's this combination specifically of a high core inflation rate as we start to get stimulus on the monetary policy side and the fiscal side at the same time, which is really concerning markets about a reacceleration of inflation. That right there is why we're seeing the response in markets that we've seen so far. So what effect is a reacceleration of inflation going to have on the markets? Well, if you have a look at the last time we had this acceleration of inflation, it was throughout 2021 and into 2022 in the aftermath of all the printing that we saw and the stimulus, the last time we had that kind of stimulus after the COVID correction in the markets and the recession. Now, if we go back to the hedge-quantitative trading platform and have a look at what happened to the dollar, when we have an inflationary outlook, and I mean, look at this, December, February, March 2021. This is what the reaction was to the US dollar when we have that acceleration of inflation. You can see the dollar responded by going up, not down. And this is again because we had the reacceleration of inflation, and then we had bond yields going higher. And as interest rates go up, this drags the US dollar higher. So this is why we're seeing this kind of reaction now in the US dollar, because the markets are not holding the same inflationary expectations as they did in 2016, 2017 when Trump cut corporation tax. They're looking at it more through a 2021 kind of blow off top perspective as to what is likely to happen if we do get a reacceleration of inflation in the US. And if we pull up the S&P 500 in the Hedge Dash platform, what else do we see in 2021 in equities? Yes, the dollar was rallying, which is deflationary because yields were going up. But because you're getting it with that acceleration of inflation, you see equities also rallying throughout 2021. It comes to a head in 2022 when interest rates get too high and then we start to get the correction. So again, equities, the dollar and bond yields are not all going to go up at the same time forever, but you have this moment in time where you get the acceleration of inflation, the dollar goes up, interest rates go up, and equities go up at the same time before interest rates get too high, the dollar gets too high, and this starts to have a negative effect on equities. But we did see, before we started to see the bear market, we did see a melt up in 2021 in equities, the US dollar, and we also saw Bitcoin outperforming at the same time as well. Now remember, it's not just tax cuts that Donald Trump is looking at. He's looking at imposing tariffs. So what effect is that going to have on the economic regime in the markets? Well, if you head back to Bloomberg, you can see the article picks up here with back to the subject of tariffs and how it ties into inflation. If anyone tells you Trump's first batch in 2018 didn't have an effect, consider this. The average spot rate for 40-foot container from China to the US West Coast rose dramatically after Trump introduced wide-ranging tariffs in 2018. And this is because tariffs are taxes and they're paid by importers and ultimately consumers. So what this means is that when a tariff is imposed, the importer pays the tax. And if it's a domestic company in the US, what they tend to do is just raise their own prices in order to offset this higher tax. And if they're raising their own prices and consumers are paying slightly more, this is going to be inflationary. I mean, the definition of inflation is an increase in the general price of goods and services. So the markets are facing a scenario here where from a base of 3.2% core inflation in the US, we're looking at potentially stimulus on the fiscal side with corporation tax cuts, stimulus on the fiscal side with the imposition of tariffs, which are inflationary. And then on the monetary policy side, we're looking at more stimulus with the Federal Reserve in a cutting cycle, as opposed to a hiking cycle, which they were in 2016, 2017, when we got the first corporation tax cut. Okay, so what target should we really be looking for in the dollar index this year? Well, if we go back to the Hedge Dash quantitative trading platform, I'm on the weekly chart. If I just simply turn on the yearly levels here, what this is showing us is the levels this year. So from the beginning of this year, where the dollar is likely to trade to with roughly a 7 out of 10 chance, 70% chance, and roughly a 95% chance. So looking at this here, what we can see is there's a very, very good chance we come up to the 107.24 this year. Now that could happen, within a few weeks. Again, we've only got kind of 8 weeks left of the entire year now anyway. So the 107.24 is where the next target to the upside in the US dollar is. However, here's the key. If we start to push higher and we trade above the 107.24, I mean, we could easily come above the 108 by the end of the year. What we're doing here is we're breaking out of a major sideways consolidation, and with a failure to make a low over here, we're actually breaking into a potential third wave. Because as the market comes down, fails to make a low like this, and then you get the break of the high, that's where you get those reversals, and that's where you get those third waves kicking in. Now, what usually coincides with third waves technically in a market? A fundamental catalyst. Do we have it? Well, we've just looked at exactly why we do have that. Now, there is a very small probability, maybe a 5% chance we come up to the 113 this year, but I would be looking anywhere between at least the 107.24, this prior high, and maybe you could say the 108.50, maybe 109 if we get a strong move. But certainly going into next year, I do think next year we could be making our way up to the prior high in the dollar and up to the 115 mark. So if we're looking at potential reacceleration of inflation on the macro side, and we're going to likely see the dollar respond by moving higher as bond yields go higher, and we're likely to see stocks rallying because an acceleration of inflation is inflationary, and this is bullish for stocks, at least in the near term till yields get too high, is there any way we could drill down and find some alpha and see if we can find a stock that can outperform the market over this period if this is what's coming? And the answer is yes. There's a few candidates, but the obvious one is Tesla. We revisit Bloomberg with the headline, Tesla soars as Musk's bet on Trump is seen reaping rewards. Republican nominee praises carmaker CEO during watch party. Musk has downplayed risks to EVs, emphasized deregulation. Tesla Inc. shares climbed as much as 15% in early US trading as investors wager the car maker run by Elon Musk will be a major beneficiary of Donald Trump's return to the White House. During Tesla's quarterly earnings call last month, he called for a federal approval process for autonomous vehicles and said he would try to make that happen if tapped for a role in Trump's administration. The Tesla chief executive officer was arguably the most prominent supporter of Republicans this election cycle, backing them with more than $130 million in spending and relentless messaging on X, his social media network. While Trump criticized electric vehicles throughout his campaign, he softened his tone somewhat after Musk's endorsement. So of course, one of the biggest beneficiaries of this is likely to be Tesla, because he backed the Trump administration during the campaign. He gave them money, he gave them funding, and he took a massive personal gamble to do it, because had Trump not won the election, of course, this would have had negative consequences probably for Musk and also Tesla, on a regulation level by the new administration. So looking at that from the other side, with Musk backing, as it were, the right horse in the race, which ultimately won, he is almost certainly going to benefit, and his company is likely to benefit from the next 4 years of a Trump administration. And as you've just seen from the article, this is most likely going to come in the form of deregulation of the electric vehicle sector, and this is going to allow Musk to scale up his business, especially on the autonomous side, much more than he would have been able to do under a Harris administration. On top of that, we just had Tesla earnings out for Q3, and they massively outperformed expectations. Tesla soars to the best day in 11 years after a blowout quarter. Carmaker beats estimates for earnings and auto profit margin. CEO Elon Musk predicts strong growth in deliveries next year. Tesla Inc.'s shares surged the most in more than 11 years after the carmaker reported surprisingly strong earnings and forecast as much as 30% growth in vehicle sales next year. Third quarter results were buoyed by Tesla turning a corner with the Cybertruck, which generated a profit for the first time, lower material costs, and expanding energy business, and sales of regulatory credits to automakers that need help complying with emission limits also contributed to Tesla's best quarterly earnings in more than a year. So now, not only do we have that big macro driver for Tesla to the upside to really support the bullish case over the next 4 years, that he basically funded and backed the Trump administration, and now the Trump administration has gained power and won the election, he's likely to benefit and he's likely to get something back from it. Not only that, but we just came fresh off of the best quarterly earnings in more than a year for Tesla. So you've got this dual bullish catalyst now, which can really drive Tesla to the upside, especially if we're going into a more inflationary environment and stocks overall are going to head higher. So where could we expect Tesla to go for the rest of the year? Is there runway left in Tesla this year, or is this something that we might have to look at next year? Well, I do think Tesla could go to the upside next year as well, but we've got plenty of runway left this year. You can see Tesla is nowhere near its upper bound, and the upper and lower bounds here are likely to cap moves in Tesla with roughly a 70% expectancy for this entire year. So even if we were to come up and take out our upper bound, our yearly upper bound from the start of the year, we have roughly 42% to the upside, so 358.68, where this market can easily get to this year without running out of steam, without running out of fuel. And we're just about to break out of a multi-week consolidation. You can see we peaked, we've consolidated into the moving average on the weekly chart, and now we're about to, what at least looks like we're about to gap up, and we're going to have probably a breakaway gap higher, taking out this prior high. And so 358.68, do not be surprised to see Tesla take out this target before the year is over. It's not a guarantee, but it's definitely possible. It's definitely on the cards. And the third asset that could really outperform during the next 4 years of a Trump administration is Bitcoin. Now, why Bitcoin? Because we have very similar drivers to Tesla in the sense that not only does the asset itself outperform in a kind of inflationary or risk-on regime, especially as equities are going up as well, but you have specific drivers within the Trump administration as well. We're back to Bloomberg as this article points out that Bitcoin has hit a record as pro-crypto Trump wins presidency again. Republican Trump declared winner in election by networks. Investors expect far friendlier US crypto rules under Trump. Bitcoin jumped to a record high, part of a wave of trades across global markets in response to Donald Trump emerging victorious over Democratic rival Kamala Harris in the US presidential election. And why specifically is this? Because Trump vowed to make the US the crypto capital of the planet, create a strategic Bitcoin stockpile, which is going to bring demand into Bitcoin and push the price higher, and also appoint regulators who love digital assets. On top of that, you can see Bitcoin is just about to break out of a range that it's been in since March of 2024. So just like Tesla, you have Bitcoin outperforming in an inflationary environment anyway, but then you add to Bitcoin the bullish drivers specifically from a Trump administration, that kind of trifecta we just looked at, where they're going to have less regulation, they're going to have regulators that are more friendly towards crypto, and they're going to create a strategic Bitcoin stockpile, making the US the crypto capital of the world. And so you might be asking the final question, what's the upside target in Bitcoin? Well, it's Bitcoin. Who knows how high Bitcoin can go? You don't put upside targets on Bitcoin. The very final thing to note is everything we looked at in today's video is of course dependent on the US avoiding a recession, because in a recession, Tesla and Bitcoin are likely to suffer, at least in the near term. The dollar can still go higher in a recession, but we're specifically looking at a scenario where we get that stimulus on the fiscal side coinciding with the stimulus on the monetary policy side with rate cuts, and the US avoids recession, in which case we start to see a reacceleration of inflation. So that is it from me for today, guys. As always, I hope you enjoyed today's video, and if you did, why not consider joining us in the GMT training room each day, where I look at the best markets as well as sharing real-time setups that I'm personally looking at trading with members as part of our GMT training program. Don't forget, you can also get a 2-week free trial to the cutting-edge Hedge-trading app used in today's video by heading over to www.hedge-.com. Access to the cutting-edge Hedge platform is included with every GMT membership.